Welcome to System Trader Podcast. Listen to interviews with top traders and find out how the most successful traders beat the markets and what are the secrets of their success. This is System Trader Podcast with your host, Jack Lempart.
Today I have a great pleasure to interview a true icon in the world of systematic trading. Ladies and gentlemen, today you can listen to my interview with Perry Kaufman. He began his career in the aerospace industry as a rocket scientist, and his work was used in the Apollo missions. Then he moved to trading. His trading career began in 1971 in the futures market, and since the very beginning he was involved in constructing algorithmic trading systems. He was working with the greatest CTAs and financial institutions. He's an author of many highly acclaimed books, and in this episode we talk about topics discussed in his latest work titled A Guide to Creating a Successful Algorithmic Trading Strategy. So let's start. I hope you'll enjoy. Hi Perry, and welcome to my podcast.
Oh, thank you, Jacek.
Thank you very much for accepting my invitation to the show. You are very well known in the industry. Could you please, however, give us some short background about your trading career?
Well, short is going to be a problem, but I'll do what I can. I think a lot of people know that I started in aerospace and worked on the navigation for Gemini, which was the predecessor of Apollo, since you have to do the navigation before you're ready to use it. But when I left aerospace, I formed my own computer company, and early on, we got a client who was interested in an options strategy. This was London options, not these wonderful things that we have these days, much more difficult to deal with. And one thing led to another, and we started doing trend following of futures. And that was because when we were in aerospace, we used exponential smoothing to track the path of missiles. And we applied that when we weren't very busy to the stock market. And way back then, the stock market was very trending. You could use almost anything. And so we're all quite successful trading our small stock portfolios in our spare time. And from there, I moved into agricultural markets, learned a lot about agriculture, became a partner in a farming operation in central United States, in Illinois. And from there, I went to New York and developed systems for what was at the time Bache, Halsey, Stewart, and Shields, which turned into Prudential Bache at one point. So I came up that way. I formed a company. Well, I worked in Bermuda for an oil company as a consultant for about 12 years, where we traded the largest proprietary account, I believe, in the world. Afterwards, I formed my own company with some friends to trade futures. We did that for the 10 years from 1990 to 2000, sold the company to ED&F Mann. And after that, I worked with Graham Capital Management, revising their programs. I work with Synergy, which is a big electric company in their proprietary trading, and then with Mizuho, a Japanese bank, for their fund management. And then I dropped out of that and just now provide some trading signals online on a website called kaufmansignals.com. And my wife and I trade our own money at the same time. And we do some consulting. So that's my history, and here we are.
Thank you very much, Perry. Very interesting, especially that you are coming from aerospace industry, which seems to be very rare that someone is working there. I haven't met anyone before working in that industry. So
you see?
Yeah, but
I've met a lot of people working in that industry because I did work there. And actually, one of the other very good analysts, John Ehlers, I don't know if you know his name, but
yes,
John Ehlers
yes, I know.
worked and retired from Raytheon, which is in Northern California, and he was responsible for the smart bombs. So, there are, besides doing this MESA system, because he loves cycles, there are people hiding in the woodwork that that were in aerospace that moved into trading because it's wonderfully challenging and can be limited to mathematical solutions, which we like.
Yeah, very, very interesting. Thank you for that. Today, I'd like to talk with you mainly about how to build own trading systems from the ground up. I read your book titled A Guide to Creating Successful Algorithmic Trading Strategy, which I found very good because although it's a tiny book, but in one place you have covered answers to so many questions asked again and again by traders, especially the systematic traders. Let me ask the first question then, which may seem a bit strange. Why systematic trading? Why not discretionary?
Oh, I think that question, while important, has been discussed quite a lot. One of the problems with discretionary trading is that, by the way, that background noise is our dog. One of the problems with discretionary trading is that it can be inconsistent. A discretionary trader can be brilliant, make a tremendous amount of money, leverage everything that they're doing. But it's very difficult, very hard to maintain the level of skill necessary to do that. So even discretionary traders use some systematic help, either indicators or some patterns that they're looking for in order to qualify the trades that they want. I mean, there are some discretionary traders that will say, okay, I expect the US dollar to rise against the Canadian dollar because our economy is doing better. I don't know if that's true or not, but they will make this fundamental decision and then buy the US dollar, say that sell the Canada and hold it for as long as they feel that makes sense. It's very difficult to put parameters on that. How long do you hold it? What is the expectation for profit? How do you control the risk? The nice thing about systematic trading or algorithmic trading is that you can test your ideas. You can see whether or not a trend following system is robust. That is, does it work for most markets? What is the range of calculation periods, say 40 days to 120 days, that works? And you can get an idea of the amount of risk involved in doing that trading. So there has been a shift in the industry, which originally did not like algorithmic trading. The fund management people did not like it because it appeared to be too mechanical, and they felt that a human being could overlay important information on that and make everything better. It turns out that doesn't seem to be true. I think recently it was BlackRock that has eliminated this discretionary portfolio management in favor of algorithmic portfolio management. It's more accountable. For a big company, you don't have to make excuses when a person doesn't work out well or when they take too much discretion. So algorithmic trading has a tremendous number of advantages, primarily understanding expectations. And I think that's the important thing. Now, what we'll discuss, I think, as we get further along, is how to be sure that the results that you're looking at are as close to realistic as possible, because everybody knows that computers are powerful. You can overfit anything. And when you overfit a system, that is, you come up with parameters that appear to be perfect, then those have very little chance of working in the future. And so what we need to do is understand how to test a system so that we get realistic results and we can expect something similar to that by trading.
Okay, thank you very much, Perry, for that. Very interesting. We'll get to that topic closely soon. But before that, I wanted to ask you one more question. At the beginning of your book, you mentioned that, among other people, Linda Raschke had some influence as well, at least some influence on the content of that book. And I had the pleasure to interview Linda recently, and she described herself as a discretionary trader, although she's in fact modeling the market. So as you mentioned, she's in a way also a systematic trader, although she says she describes herself as a discretionary. But she has, let's say, I don't know if it's a good word, some problem with a 100% mechanical approach. For example, on a discretionary basis, she says that she can increase her leverage with a lot more aggressiveness that she would ever do on a mechanical system. So how would you comment such opinion?
Well, you're very perceptive. She is really very good, but she is much more systematic than she'll admit. She has people testing things for her and understanding rules in programming. But then she does choose to select which trades she wants. So she as a trader, you develop some sense of which trades might be better than other trades. A system does make mistakes. I mean, not that it makes mistakes, I'm sorry, but it has bad trades. A trend following system, for example, only has about 30% profitable trades because it takes a trend position and the market turns, it gets out quickly, it turns again, you get back in. So it has a lot of false starts waiting for that bigger move to occur. Now, as a discretionary trader, perhaps you can avoid some of those false trades. I know Linda likes to wait till after a trend signal to find a better entry point. Now, I think she could probably program this to be more mechanical. I just don't think she wants to go that far. It's just a personal decision. But in terms of her leverage, the fact that she's willing to leverage up, I have some comments about that are quite important. But we probably should save that for a little later. It has to do with how you weight the various stocks or futures positions in your portfolio, and why you would choose or not choose to put more money on one than another. So let's not forget to talk about that later on.
I know that your bias is toward fully automatic trading, but does it mean that by word automatic you mean as well the execution of trades? Probably when you're trading on low time frame, it may be difficult to trade manually, but excluding such extreme cases, in general, do you see a problem if someone follows a mechanical system manually?
No, actually, I trade a trend portfolio in stocks. I trade a number of portfolios, but I enter the positions with my own style. I have to get, when I have a buy signal in a stock, I have to get in. But what I do normally is if the market opens higher, I do all my sells, my liquidations in the stock market because I'm long only. I do all my sells first. If the market opens lower, I do all my buys first. So I'm really doing that because that's what floor traders do. They assume the market's going to reverse. And in fact, it does a large percentage of the time. So a lower open, I'll wait a few minutes and I'll start buying. And then after 15, 20 minutes, half an hour, when the market has reversed, which it does, I will sell the positions that I wanted to close out. And I'll do the opposite if the market goes the other way. One thing Linda Raschke says that is very important is that in the morning, the market is mean reverting, and in the afternoon, it's trending. And it's really important to remember that because in the morning, there are a lot of different people trading in and out of the market. You have orders on the open, you have economic reports, and people shift positions. You've got Europe and the US open at the same time. So there's a lot of up and down in the morning while people try to decide what's going on and get their orders placed. That seems to end after lunch in New York, which is 12 o'clock, 1 o'clock. After that, the market seems to calm down. The volume has dropped off quite a lot. The volume is U-shaped. There's the most volume on the open and close, and then it forms a U during the day, where in the middle of the afternoon, it has the lowest volume. So once we pass the afternoon, the market usually picks a direction and starts moving in that direction as a trend. And I go by that. So I will trade sometimes in and out in the morning, looking for a pullback in a market. So if, for example, I'm long everything and I get a favorable quarterly report from the company and the market jumps up 8%, I will wait to see that it's stabilized. I'll sell the position and then wait for a 30-40% pullback from that to re-enter my position. So as a systematic trader, I'll always go out the day with the positions held by the system. But because I get bored and I think I can improve results, I will trade in and out of specific situations like this, a big jump on a good income report from a company. And so anyway, it's something that everybody can do, but if you're a systematic trader, you have to be sure to be back on the system, and you have to have confidence that if you don't have an opinion, if you don't know something specific that you want to do, then stay with the system because the odds are in your favor.
Okay, thank you very much, Perry, for that sharing that valuable stuff. So, as you said, we have to be confident with the system we are following. So, could you please, I know it could be a very long answer here, but for that question, but just in a few sentences, describe the process of developing a trading strategy. What should be the, let's say, high-level steps of the development process?
It is a good question. It's not always easy to answer. For beginning algorithmic traders, I would suggest that they inspect only the trend or trend following methods. Macro trends have proved to be very, very successful over at least 40 years. And by a macro trend, I mean any kind of a simple trend system. It could be a moving average, it could be a linear regression, it could be a breakout. But it has to be slow because the market doesn't go one direction every day. And so you should start looking at applying a trend, a slow trend or macro trend to different markets and understanding the risk in that system. That is, it will, my experience is that these macro trends will make money in virtually everything. But the bad news is that when you have a long-term trend, there will also be a number of reversals, and the trend won't change. You'll have to sit there while the market goes the wrong way, because that's why trends work. But anyway, so the new systematic trader should be comfortable with the trend, because even if they don't become trend-following traders in the long run, they'll use the trend to filter other systems. If you have a pattern system and you believe that the market reverses every 3 days, then you'll find that you will be more successful if you only take the reversals in the direction of the trend. So there are simple ways to start out algorithmic trading that almost anybody can do. You can do it on a spreadsheet. You don't even need a sophisticated platform like TradeStation or NinjaTrader or any of a dozen helpful pieces of software. So you could do this and experiment on a spreadsheet and see how it works. Actually, Jacek, I don't know if I answered your question or if I got off on another direction.
No, that's very good what you said. I fully agree, and thank you for that. I wanted also to ask you then, once we have the trading idea then, and we have we translated our idea into the programming code, I mean, on some trading platform, let's say, then we have some data set on which we can test it. And then you mentioned in your book about having the two sets of data, the in-sample and out-of-sample. And here is a big topic which I will open now, because in the industry, some people are also using, for example, the walk-forward analysis, which basically is rolling in-sample and out-of-sample tests, and each window gives the best parameters for the next window. But when I studied your book and your previous books as well, I haven't found explicitly such concept, although you mentioned it's good to, for example, you mentioned that it's good to alternate the validation data so that it comes from a different market periods.
Yeah, I understand where you're going with this. The difference between a scientific approach here to testing and some common sense. There are different ways to test. Now, the true scientific way is to separate in-sample and out-of-sample data. It's the check to be sure that you haven't cheated. And so what you do is you say, let's say I want to test the futures markets with 20 years of data. I test it on 15 years, and I leave the most recent 5 years. And in the early 15 years, I can do anything I want. I can look to see what trades didn't work. I can fix the rules. I can fiddle with it. I can add a moving average. I can add volatility. I can do anything I want. Until I say, okay, I have the system that I want. It seems to work perfectly on those 15 years. Then what you do is you test those rules on the next 5 years, and you find out that it's terrible. And it always happens that way because you try to make it perfect in the in-sample data. And when you make it perfect, you are trying to fit the rules to specific situations in the past. That's why one of the sayings I have in the book that I learned from a friend is loose pants fit everyone. But you can't have a system that works on different markets and different time frames if the pants are too tight. So, and unfortunately, loose pants means I'm only going to have a simple moving average. I'm not even going to have a stop loss. I may have profit taking, or I may have volatility adjustment that says when the market's volatile, I trade less. But that's about it. And if you have very few rules, the chances of it working on a lot of markets is very good. Unfortunately, it will also have risk. The only way you get rid of the risk is within the portfolio part of the program, not in the systematic part. Or not in the trading system. So you're looking to find something that works or makes money across as many markets as possible. Even though some markets will only make a little, some markets will make a lot, it doesn't matter. The portfolio program will sort them out later and pick the ones that you want to trade. So don't spend too much time being sophisticated about the underlying system. I believe you'll find that the portfolio program is at least 50% of the problem. So we save a lot of the sophistication for later on when we select which markets we want to trade. And in the systematic part, we keep it as simple as possible.
In that topic, I found, at least I've got a feeling that you prefer, because at some point we have to define parameters which we will have in that system. And I've got a feeling that you prefer to define a range of robust parameters and trade more than one set of parameters at the same time. So it's a kind of diversification, let's say. You don't say anything, at least in your book, about reoptimization parameters, because you never know what is best, what will be best tomorrow. You know what was best yesterday, but you cannot say what will be tomorrow. So I've got a feeling that for that reason you are using the set of parameters. Am I correct?
Yes, but let me just put this question aside for a second and go back, because I didn't answer your previous question completely. We were talking about in-sample and out-of-sample data, and I said that you'll find that if the rules too complicated in the in-sample, then the out-of-sample won't work. But let's also talk about the way in which we use the data. One of the problems is that the markets have changed over time. So you may want to do the opposite. You may want to use the more recent data as the in-sample data and then look to see whether that worked further in the past instead of the opposite way. But to me, neither one of those is a good solution. So what I did with my data is I look at alternating periods. So for example, if I have 20 years, I will look at 2 or 3 year intervals. So I will use a moving average, for example, and I will only show the results for alternating, say, 3 year periods, 1990 to 92, then 1996 to 98, 1990 or 2001 to 2003. So I make the program so that it doesn't show the performance in between those years. You run the same trend for the whole time, but I'm able to show only the performance in the selected years, and that allows me to use older and newer data as in-sample, out-of-sample, which I think is a better solution. It's more complicated, so that this will only help those people that are more adept at programming these things. But it is, for me, the solution. The other simple thing is just to test more data. The more data you test, the less likely you can overfit anything. So you don't want to test the last 3 years of a stock. You want to test the last 20 years, and you'll be safer. And that's about the best thing I can do with in-sample, out-of-sample. It is a dilemma, and most people cheat. But let me just discuss the step forward or walk forward testing. There are a number of issues with that. It is technically the perfect solution. You optimize parameters for one period. You use that going forward for 3 months, 6 months, a year. And then you move the whole process forward and you test again and do that. There are two big issues with this. First, the in-sample periods tend to be short, 3 years, 4 years. They're not enough to get a good sample of a long-term trend. A long-term trend may only have 2 or 3 trades a year. And if you only look at windows, walk forward windows of 3 years, you're not going to get many trades, and your performance in those windows will be very erratic. So I don't care for that. The second is that if you run this walk forward test and you don't like the results because the out of sample isn't so good, and you go back and you correct a rule, you no longer can use that method because it's no longer out of sample. You've now overfit the data. The problem with walk forward testing is you can only do it once, and I think that's very unrealistic. Everybody is going, if you don't come up with the perfect system the first time, you're going to want to look to see what I could have done to improve things. And you're not allowed to do that with walk-forward testing. So for that reason, I don't discuss it in my book because I think it's impractical. Should we now go to the multiple parameter question?
Yes, if we could then. Thank you very much for that. Yes, indeed. If we could talk about these parameters, because it's very interesting, and I need to admit that it's a slightly maybe different. I mean, there are different people in the industry and having different approaches, and your approach seems to go towards using the same system running in parallel on different parameter sets, so that, as you said, you are using a longer period for your in-sample testing, and then you are covering more market periods with the different characteristics, and then you don't know what will happen, of course, tomorrow. Therefore, you prefer to use different sets of parameters because the average will give you more or less what you saw before.
Yes, I see you understand. So let me repeat it in my words. One of the problems is if you do your optimization and your testing and you try to come up with a moving average speed, say 80 days. 80 days is a typical macro trend speed. And you'll find it will work in general over most markets. And that's good. The problem is that one trend speed, like trading one stock, could give you the best result or the worst result for the year. When you trade two stocks that you believe work, you get an average result. You don't get the best, you don't get the worst. You get a more stable and hopefully good result. So the same thing applies to parameters. If I have a trend following system, I'm pretty sure that everything between 40 or 60 and 120 days or 150 days will be profitable. They will be profitable to different levels, and they will be profitable in different years. And I don't want to put all of my money on one trend speed because it's going to flop around a lot. Even if it turns out to be a good choice, it will flop around. I'd rather have a more stable return. So what I do is I will pick at least 3 parameters that are spread out across the range of parameters that make money. It could be 30, 60, 120. It could be 40, 80, 160. Notice I double the calculation period because it keeps the percentage the same. If you were to pick a 30 and a 40-day moving average, you would have a 25% or 30% difference in the calculation speed, which is quite a lot. The results would be quite different. If you were to pick a 140 and 150-day moving average, it'd be almost identical. And so you need to spread out your parameter selection across a wider range. And that's the same with profit taking. If you were to do profit taking, you would use, the typical way is to use a profit factor times a true range. And you would pick not 1, 1.5, and 2 as your profit targets, but you would pick 1, 3, and 6. You need to spread them out to give yourself a better distribution. In all cases, say in the case of profit taking, you pick the profit level that you know is going to be good. Let's say a factor of 3. So the entry price plus the 3 times the average true range is your goal. And then you take that and you spread out your profit taking around 3 so that if you had 3 profit taking levels, the average exit would be your target of 3. So it could be 1.5, 3, and 4.5. So that you can take profit sooner at your original target and later. The nice thing about that, and I know we're drifting from our conversation, but the nice thing about that is that once you take your first profit off, you're reducing your exposure and your risk. When you take the second of the 3 off, there's almost no chance you will turn a profit into a loss. And then the coup de grace is being able to get the third leg off. And then you have accomplished just what you want. So let's go back to the parameters. Again, let me just repeat that the reason for multiple parameters is that you don't want to put all your money on one chance. You want to stabilize your returns by getting an average of all of the moving average returns. So what you might do is say, take the average return of the calculation periods from 40 to 150. Look at the test results and see what the average returns are. And then try to spread out your selection of parameters so that those return the average. Now, I do that myself by using all of the parameters. So instead of picking 3, I will pick 15 or 20 because it's just a computer. I run 20 different combinations and I put 1/20th of my investment on each one. I get trading signals. I net out those trading signals so that I get one trade out of it, and it's based on the average of all of those other signals. The nice thing about that is that as the trend turns from up to down or down to up, some of these trends will turn faster, and I will actually be scaling in and out of my trade based on how strong the trend is. So you have a really strong uptrend, as we had for so many years, you'll be 100% long. But in the past couple of months, as the market has turned sideways to down, you will start scaling out. So now you may only have a half a position on instead of your full commitment. And so you won't be as exposed to the risk until the market makes a decision whether it's going up or down. If it goes down, you'll scale out more. If it goes up, you'll start to get in again. I find those are nice solutions that are solved algorithmically.
Yes, very interesting. And I think also, Perry, that this is also helpful from the psychological point of view, because at least that's my feeling. I see that I'm partially already, I've got some profit already. My exposure is decreased, so my risk also is decreasing. So it's not like I'm still risking losing my paper profit because I already have some profits in my pocket.
Yes. Now, the problem with taking profits is that sometimes you get all your profit and you're very happy, and then the trend continues and you have no position and you miss out on a much bigger profit. So, along with taking profits, you have to have a re-entry rule because you can't allow a very big trade to get away from you. And the re-entry rule can be based on a couple of different things. It could be a pullback towards the moving average so that you take profits off and then it pulls back halfway, you get back in. It could be based on volatility, which I like actually, because normally when you get profit taking, the market has moved up faster and is more volatile. So you keep track of when you got out what the volatility of the market was, and it could be in true range, it could be in annualized volatility. Calculations are easy to find. And then if the volatility quiets back down to normal, whatever the normal volatility was before the market started moving, you get back in. And I find that a more interesting solution. So you're getting out when the market is more volatile, and you're getting back in when it quiets down. Now, it may turn out that it quiets down after a pullback. It may turn out that it quiets down after you've taken profits without actually pulling back. It doesn't matter. When the market quiets down, it's absorbed everything, all the news, and it's starting all over again. So I find the volatility is a very interesting and somewhat different way to re-enter a market after you've taken profits.
And now, short break for our sponsor of the show, Candle Scanner. Candle Scanner is a technical analysis software package created for investors interested in candle patterns. What makes Candle Scanner application exceptional is that, from the outset, it has been specifically designed for the detection of candle patterns. It is not just an add-on to an existing analysis platform, but a specialist charting application written by people with an extensive knowledge of the topic of candlestick patterns. It is suitable for both seasoned traders and complete beginners. With Candle Scanner, you can do the following. Quickly scan candlestick charts to find all occurrences of candle patterns. Measure the efficiency of patterns, that is, are they working as you expect them to? Build trading strategies based on candle patterns and simulate transactions. And soon, define any custom pattern you want, then scan the charts and measure its efficiency. And all this without any coding. Please visit candlescanner.com for more details. So I've got a feeling that we were mostly discussing if we are talking about the profit taking, about the short-term trading, because short-term trading strategies. Because in your book you mentioned that when we use the trend following strategy, macro trend strategies, there basically we don't even use stops as such or profit taking, because as you mentioned there, we should go out of the market once the trend reverses, and also this is our stop at that moment. And also, as for the profit taking, we will not take any profits because we are looking for as long trend as possible, and we are also using very, very slow trend, very slow, for example, moving average. Therefore, the profit taking is not the case.
Yeah, let me approach this a little differently. I think it's time to discuss the risk in the portfolio, because you're right, I didn't discuss stops because I have a different way of controlling the risk. And I don't like stops. I find over the years that whenever I get stopped out, it's at the worst possible point. So I find it very frustrating. So I try to solve the problem differently. So let's first start with the idea of how you size a position, because sizing a position is very important. When you have a portfolio of stocks or futures, you want the risk of each trade to be equal. You don't care about the profits. The profits will take care of themselves. The risk needs to be equal. When you equalize the risk of every trade, you maximize the diversification, which means you smooth out the results. So in stocks, the easiest way is simply to take your investment. Let's say you have $100,000. You're going to trade 10 stocks. You divide your investment equally into 10 parts, $10,000 each. And then you divide that 10,000 by the stock price. Now, it's not a perfect solution, but higher prices normally mean more volatility. So a stock that trades at a higher price will have a smaller position. Now, just for those people who are really more in tune with the dynamics of this price and volatility, it turns out that higher prices are somewhat less volatile than lower prices. In fact, I don't trade anything under $5, a stock under $5, because stocks priced under $5 are so volatile and so erratic, that they're hard to predict. And they can distort your results terribly. So actually, the volatility becomes much higher as prices get much lower. But in general, you will get more risk on a higher price stock. So, Amazon at whatever it is, 1,500, is clearly you're going to need to trade fewer shares than some stock at $30 in order to equalize the risk. So anyway, the first part is to be sure that you're not putting more risk on any one stock, because if you do put more risk on one stock, then that stock has to have a bigger return than the other stocks to make it worthwhile. And I don't know how to predict which of the 10 or 20 or 30 stocks in my portfolio is going to perform best tomorrow, next week. I really have no clue. They're all good performers, but which one is going to be best is beyond me. If I knew that, I would put all my money on that one stock. So I can't do that, so I trade them all equally. Okay, now, having done that, how do I create a portfolio? It turns out that the simplest measurement is the best. And this goes on almost everywhere. I said that the fewer rules are better. For portfolios, simpler is better. The best way to decide what stock goes into your portfolio is which stock performs best on your system. So if I have a simple trend following system, and I scan 250 stocks, I look at the performance of that stock. Performance meaning dollar return of that stock under the rules of my system, how it bought and sold, for a combination of the last year and the last 3 months. And I weight those equally. So I look at that, I combine those two measurements, and then I rank the stocks by which ones did better according to those measurements. And I pick the 10 top ones to trade. And what happens is there is persistence. The stocks that are performing well normally continue to perform well. And so those turn out to be the best. If I were to say, okay, I want the best stocks with the lowest risk, it wouldn't work at all, because a stock does not understand that it's supposed to make money with low risk. Each stock has their own profile. And you have to accept that and try to diversify out the risk in another way. So you pick 10 stocks from your ranking, And when one stock falls down out of the 10, say you need a little buffer zone. So let's say it falls to number 15 in your ranking. Now I get rid of it and I substitute the highest ranking stock that I haven't used. Now what this does is it may be that the stock that fell to number 15 is still profitable and still trending, but not as profitable as some other stock. So I actually get out of a stock before the trend changes only because its performance isn't as good as something else. Now, this is better than a stop loss because a stop loss, you have to wait till it loses money. And in this portfolio approach of ranking and picking the best, you're staying with the relatively stronger stocks and you're not waiting for a reversal. And so using only profits turns out to be the best criteria for selecting stocks for your portfolio. And that's true of both stocks and futures.
Very interesting. Thank you very much, Perry, for that. Very often we can hear that the volatility is good for traders because it can be translated into high profits. But I see that, as you mentioned already, the volatility, the higher the volatility, potentially the higher the risk. So I would like to know your opinion here about this here when we link that to the position sizing, because this should be linked for sure, right?
Yes, actually, volatility is my next favorite thing. I think that a volatility filter that allows you to take and not take trades based on volatility is extremely important, and it works across all markets, all futures, in almost identically the same way. So, for example, you can look at the volatility, and the volatility is measured in the standard way that options volatility is measured as the annualized risk or annualized volatility. I think for those people that don't know it, it's you take the returns, you take the standard deviation or the 20-day standard deviation of the price returns, not prices, price returns, times the square root of 252 if you're using daily data. That will give you the volatility, which is normally 10 to 20%. If it goes to 50%, I get out. And let me just mention the big picture here. A stock that has high volatility has more risk than it has return. It's certainly possible that you will make money on a stock that has high volatility. But my studies and my experience is that you can make a little bit, but you have much higher risk with a volatile stock compared to the returns. Most returns are made on stocks with low volatility. So you'll find one of the important things to do in a portfolio is you keep track of your portfolio returns on a daily basis, and you apply this annualized volatility measurement, and you come up with a target volatility. Now, target volatility is one standard deviation of these annualized returns. And most professional managers target about 12% volatility. Now, that's easy to do in futures, not as easy to do in stocks, but the principle is much the same. So if we're talking about futures, and you look at your performance, now I'm not looking at the individual stocks or futures, I'm looking at your portfolio returns, and your volatility is 16% when your target is 12%, then you have to reduce your position sizes by a factor of 12 divided by 16, or whatever it is, 25%. If you're and believe me, when you do that, you're actually not losing as much return as you're reducing the risk. But the real gain comes when you're trading and making money and you find that the volatility of your returns is only 6%. What happens is you're only making half as much as you should be making. So you should be doubling your position size. Again, this is easy with futures when there's leverage. In stocks, it's easy to reduce your leverage when the volatility gets high, but you would have to buy leverage by borrowing money in order to increase your position. When interest rates were very low, that was still a very good way to do things. But anyway, let me just go back and mention that the real gain from this leverage manipulation in your portfolio is when volatility is low, that most of the money is made on low volatility. And if you don't increase your leverage and raise the position size when volatility is low, you will come away with your underlying system making twice as much as you actually made in real life. And that's a problem. The other thing that's quite similar are people that trade and do well trading their system and forget to increase their position size as they're making money. So that if you made 20%, but you're still trading the same position size when you started, then now all of a sudden you have 20% of the money idle and you're making 20% less than you should. So you really have to keep on top of your own trading to make sure you're trading all of the money. When you're making money, trade more. When you're losing money, you set a smaller position. And that you reduce your position size when the volatility is high and you increase your position size when the volatility is low. And these are really important, and at least as important as your underlying system.
Okay, thank you very much, Perry, for sharing that very valuable information. So I've got a feeling that the risk management, in fact, is your main focus more than even maybe the perfect entry and exit as such, but just to know what is your real risk. And if we are talking about the portfolio, is there any easy answer to the question if we want to have either multiple different strategies, or maybe it's better to diversify across many markets? Do you think that one or the other approach is better?
Another good question. You must have been reading my book.
Yes, I did.
Yes. I think we've all learned that market diversification is almost impossible. In the stock market, when things go wrong, like yesterday, when there was a big decline in the U.S. market, I looked at my portfolio and virtually every stock in my portfolio declined about the same amount. And I'm holding things in different sectors. It just doesn't work. What does work is strategy diversification. So if you really want to be diversified, you should have a trend following system. You should have a pattern system that could be a 2 or 3 day trend. It could be some sort of a I seem to have lost the word, but where one market goes one way and one goes the other. We'll figure that one out. But yes, let me just. Why can't I find this word? What's the word when? When one market goes up and the other goes down, they're diverging. Diverging. Yes. Yeah, so I was saying that strategy diversification is much more important than market diversification, but you do have to find strategies that are different. And a pattern is good to put along with trend following, and two markets that are diverging, and you're trading the way in which they diverge, or a classic divergence is when prices are going up and momentum is going down, and you see that you can anticipate a change of direction. Anything that is different. You could add pairs trading, some arbitrage, because when you're doing a pairs trade, it's a relative value arbitrage. You're looking at making money from one stock going up more than another stock. So if they both go down, if the whole market goes down, you could still make money on that difference. One stock goes down more than the other. Those really give you diversification. And as we saw recently, and we saw in 2008 when we had the financial crisis, everything went down. When people bail out of the market, the expression is that money moves the market. So when people get out, they get out of longs, those go down. They get out of shorts, those go up. They get out of art, they get out of real estate. Everything that was going up goes down. Everything that was going down goes up. There is no diversification. The only way to get it is with some strategies that are unrelated to one another. And of course, deleveraging is good too.
You mentioned about the pairs trading, and I found that idea also mentioned in your book. And you mentioned that it's not that profitable anymore nowadays as it used to be. But first of all, as the technique maybe is not so popular among individual traders, could you first explain that technique, that idea a bit more? And then if you could answer if such approach is feasible for such technique for a retail trader. Do you think that individual trader is able to create a strategy which is based on the pair trading?
I think you can, but you can't compete with the commercials that are doing this in milliseconds, which is the high frequency trading. You're going to need to look at trades that last 2 to 3 days, which is a time frame that a screen trader can use. And so you have to find related companies. And what you're really taking advantage of doesn't occur that often, but during earnings season, for example, one, say, semiconductor company will announce its earnings ahead of a different one. Now, they're all in the same business with the same customers in the same economy. And so if one semiconductor company has a good return for the quarter and it jumps up, then you want to sell that company and buy another big semiconductor company that has not yet released its earnings and has not moved. You'll find, of course, that the other semiconductor companies will move in sympathy with the first one, but not as much, and there will still be an opportunity to make money. So you can do that. You have to just run the difference between the stocks or the ratio of the two companies and look for the day in which that ratio jumps up or down. You then need to be sure it was on something like earnings and not a scandal or some problem, or the company lost a large contract, because the pairs trade for things like this have to do with anticipating one company's earnings ahead of the other. So you can do that. And it's a very safe trade. I can't tell which ones will make more or less money, but it's highly unusual for one company in a manufacturing industry to make money and another not to. So you can expect similar follow through. And it's a short trade. As I said, they're all going to announce pretty much within a few days of one another. So there's an opportunity there. And you can isolate it strictly by following the ratio of the two company prices, which you can do either on a spreadsheet or almost any quote equipment that has graphics will allow you to plot that.
Okay, thank you, Perry, for that. So it sounds like pairs trading is also a good way of diversification of our portfolio. So not having only some positional trading strategies, but also to have something more, let's say, I don't know if it's a good word, neutral, and like pairs trading, just to also mitigate the risk in our portfolio.
Yes. Any kind of spread trading is going to give you diversification over outright positions. So people should consider, what spreads between things make sense, and they can look it up online. There are all sorts of interesting, commentaries online that will give people ideas as to which items to trade, and you should do it. There's a lot of information out there. You just have to know what you're looking for and ask the right questions, and you'll be surprised what you can find. And then you just do a little homework and you come up with a system. And again, you don't want to get complicated. You want to find the simplest possible rules for a trading system.
Yes, thank you. We are getting slowly to the end, but I have one more question to you regarding the genetic programming, because I would like to know what you think about some software packages which are now on the market, which are using, for example, genetic programming just for automated building trading strategies. So basically, we load the data, and we have some set of rules inside, and based on the genetic programming approach, we have on the output a set of strategies. Do you think that it's possible to use such approach in a wise way, in a successful way? Because I know that it can be a way for some, especially young traders, to find a shortcut. So they think that automatically they will get some trading strategy with no effort. But of course, there's no possibility it will work. But do you think that if someone is doing that in a, let's say, wise way, do you think it can be useful to use such approach?
A difficult question. I have done that. Again, if you're trying to match trading rules to prices, the problem with the genetic algorithm is that you will succeed. Genetic algorithms and neural networks are searching methods that are extremely powerful, and I use them for other reasons. But they will find solutions sometimes where there are none. They are so good at matching rules to data that clearly, if you put in a lot of rules, it's going to overfit the solution. So the question becomes, how do you use these tools without overfitting them? And perhaps when you use a genetic algorithm, you put in 10 rules and say, okay, I only want to see the one that works the best. Because if you say, I want to see the combination of 5 that work the best, you're going to overfit it. So if you're looking to see, does a moving average work better than a linear regression, or better than a breakout, or better than a pattern or something, and you just ask for the best single solution, I think you're okay. But if you want a combination of rules, I think that you have now stepped into the realm of overfitting, and that's not going to work.
Okay, that's very interesting. So in other words, if I understood you correctly, genetic programming, for example, could be used to replace that very time-consuming and maybe boring work where you have to try again and again different combinations to see what works better. And here, if you are using this in a simple way for some very simple rules, not like you said, 5 combinations, but just to see what basically works, just to see what could possibly work, and then based on that results to continue working on your system. So that way, maybe, as you say, it could make some sense.
Yes, but not only would I want to know whether linear regression was better than a moving average, but then I'd want to know the range of parameters that work. So if I know those 2 things, linear regression between 40 and 120, now I can pick my parameters and pick the technique, and I don't have to worry about it. So I would be okay with that approach. As I said, if you start combining every possible pattern and every stop loss condition and trailing stop and fixed stops and profit taking and interrelationship between forward months and back months, then you're going to come up with a wonderful solution. You're going to get a straight line up in terms of performance, and it will, of course, never work.
Of course, I understand. Thank you very much, Perry, for that. My last question comes from the listener. Marek asks what type of tools and methods you use for data normalization. So I see that's all I have, so it's not very precise, but could you try at least to elaborate on that?
I could. Data normalization is not a clear item. In some ways, you normalize data by changing prices into an index is one way of making things the same. So often when I want to compare two markets, I will convert them to an index so that I'm looking at the percentage changes and not price changes. So that makes it easier. If it turns out if you do a linear regression on the two markets, the regression itself actually does that conversion. So if you're looking to see which of two markets is stronger, I do the same linear regression of each one over the same time period, and the one with the larger slope will be the one that's the strongest, and it self-normalizes. The other normalization concept is with indicators. So a momentum indicator, some of them, straight momentum, doesn't have a limit. It's really the difference between today's price and the price N days ago, and it can jump anywhere depending on how far the second normalization that I know has to do with normalizing indicators, and in that case we have the example of simple momentum, which is the price today minus the price some days ago. And that value of the momentum can be anything. It can be large if the price made a big move during that period, or small if it didn't. It's usually a difficult number to use because it has no bound. Instead, we do things like the stochastic or RSI, which divides the price move over that period of time by the range, high-low range of the same period. So what you're getting is a value between 0 and 100 that says today's closing price is somewhere in the range of the last 20 days or 30 days. And that value is represented by a number between 0 and 100. So that's easy to use, and that's normalizing. The problem with momentum indicators that are normalized is that if prices continue to go up, sometimes you get the value stuck at 100 for a number of days. And so one of the techniques in using them is not to assume they're overbought at 100, but wait until the number comes off 100 so that you know it's no longer just going straight up. And that's all I have on normalizing in my brain.
Okay, thank you very much, Perry, for that. That's very valuable. It seems that we have covered all questions. So, do you maybe have anything you would like to mention before we will finish today's podcast?
I think the only thing I could possibly say is that a trader starting out, systematic or otherwise, should always start small. I think actually trading is very important. You can't learn the risks and rewards on paper. I mean, you do need to go through the process, but at some point you need to get into the market, make a profit on a trade or lose on a trade. It teaches you a lot, but do it with a very small amount of money so that the actual profit or loss doesn't mean anything. It's the experience of a risk or reward that counts. And you'll find that if you do a small amount of trading with the system, you'll learn so much more than what you can do simply by looking at the numbers.
Okay, I understand. That's very valuable. So it seems like once we put real money on the table, we are really focused on the market.
Your learning experience goes up quickly.
Yeah, okay, thank you. That's very valuable. If someone would like to learn more about you or to get in touch with you, what is the best way to do that?
Well, the website that has a program that I'm offering is called kaufmansignals.com, and they can reach me by sending a note through that website, or I think it's Perry@kaufmansignals.com, and I do answer questions.
Okay, thank you. And the signals you are offering, are they also for the European markets?
No, they're stocks. Well, the stock signals are for the U.S. markets. The futures are for U.S. and Europe.
Okay, I understand. Thank you. Thank you very much for your time. It was a big honor for me, so I could have you on my podcast. I wish you all the best Thank you very much.
Thank you. Thank you very much. I appreciate it.
Thank you. Bye-bye.
Okay, bye.
That's all from my side for today. I hope you liked the show and found many valuable tips from Perry. Please visit my website at systemtrader.show/003, where I included some extra stuff related to this episode. Also, if you would like to comment this episode, you can do that there. So, thank you very much for your time. I wish you all the best, happy trading, and goodbye.